rising interest rates are like kryptonite to bond prices. At least they would be if bonds were cool enough to be Superman. They're not, but either way, rising interest rates, bad news for bonds. So does that mean that you just don't invest in bonds? I'm going to give you an alternative today. Sit tight. We'll talk about it. Hi, I'm Antonio Cibella with Vision Wealth Management. We know that interest rates are going up. You've probably seen what that's doing to bond prices. It's pushing bond prices down, which means losses. And so you've got to start to look for some alternatives. An alternative to the way most folks invest in bonds is to use a bond ladder instead of using bond mutual funds. I'll explain what that means. Here we go. So most folks invest in bonds inside of a mutual fund. That means you actually invest money in the fund. It's a pooled investment, and there is a manager or managers at that fund, and they're selecting the individual bonds that they're buying. The way those are priced, they're priced daily, as all bonds are. As interest rates go up, the bond prices go down, and it reflects in the share price of the mutual funds. You lose control over the individual bond holdings that you have when you're hiring somebody to select the bonds, which is what a mutual fund is doing. They've got a manager who's picking those things. And that's not to say that mutual fund managers are bad, because they're not. But specifically when it comes to bond investing in a rising rate environment, that can lock in potential losses. If money's flowing out of the fund, the manager's got to sell things. If he's got to sell something when the price is down, that loss just went from a potential temporary loss to a permanent loss because he had to liquidate something maybe at a time that he didn't want to. A way to get around that as an individual investor is to buy individual bonds. Don't invest in a mutual fund. A reasonable way to go about investing in individual bonds is not to say, well, I'm going to buy one bond. It's a 10-year bond and it pays me this nice interest rate, because all your bond money is locked up for 10 years. One thing that you can do as an alternative is a bond ladder. So in a bond ladder, you select a period of time, 2 years, 3 years, 5 years, and you say, I'm going to buy bonds from maturing tomorrow or 3 months from now or 6 months from now, all the way out to, let's call it 5 years. So I'm going to buy a bond that matures every 6 months for the next 5 years. I'm going to spread my money out over that period of time. What's going to happen is this. Every 6 months, you're going to have a piece of money coming due. And as it comes due, you can buy a new 5-year bond. So you perpetuate your 5-year bond ladder. The advantage it has in a rising rate environment is whoever you've purchased the bond from, whatever bond you've invested in, as long as they're still in business when the bond matures, they have to pay you back the full face value. Doesn't matter what's happened to interest rates. Now, you have to be reasonable in a rising rate environment, not to get too long with your bond ladder, because the longer the term, you could be locking in lower interest rates. If interest rates continue to rise, you don't want money locked up for 10 years, 15 years, something like that. But if you keep it on the lower end, maybe 2 years, 3 years, maybe a maximum of 5 years at this point, you'll regularly have money coming due. The fact that bond prices are going down will mean less to you, because as long as you've got good credit risk, as long as those that you've lent money to can repay you at the maturity of the bond, they have to repay you the full amount. Doesn't matter what it was priced at along the way, and they have to pay you interest along the way until bond maturity. So you're essentially acting as your own mutual fund manager, if you will, in the bond sense, in that you've built your own bond portfolio instead of hiring it out to somebody else. You've retained control over what happens with those assets, and if you keep them to maturity as everything matures, you don't have the same level of interest rate risk affecting your portfolio. Bond ladders, an interesting topic, something to look into in an interest rate like we have, environment that we have right now, which is interest rates are on the rise. People are looking for alternatives. Don't throw bonds out completely. They still have a place in a portfolio. Maybe it's in a bond mutual fund for you. Maybe you don't want to go about the bond ladder route, but it's an alternative. It's something to consider. I hope you learned something. Thanks for being here, and I'll see you soon.